This is like the nut. This is how you actually trade options. I've mentioned before that most people are under the mistaken impression that options are all about leverage. And while leverage is important, that's not really the benefit of options. The benefit of options is being able to model your view of the market, your opinion, and be able to very, very precisely model your risk as well. And you do that through something I call a 3D view of the market. And that's what this is going to be called. This is called options in 3D, how to model your market opinion. All right, so let's get started. There are essentially three questions that you have to ask yourself anytime that you want to take on a trade and use options. And those three questions will help you devise the strategy that you want to put on, or the strategy that will most advantageously take advantage. And I guess that's a little bit redundant, but the strategy that will take advantage of market conditions and where you see them going. Not everybody has a crystal ball. You don't always know where things are going. However, there are a lot of events that happen with Apple, for instance, that are very, very highly predictable because they happen over and over and over and over again. Again, more from the Department of Redundancy Department. Now, the three things that you need to keep in mind, or the three questions that you have to ask yourself when you're putting on an options strategy or creating a model of your opinion of the market are: the first is, are you bullish, bearish, or neutral on Apple? And it's to the degree too. Are you kind of middle of the road? You don't think it's going to go anywhere? Then you're kind of neutral. If you think that Apple's up for a huge bull run because they're coming out with unbelievable products or their earnings are going to explode, then you're bullish. If you think that the analysts, being the analysts that they are going to smack down Apple, then maybe you're bearish. All right. So that's the first thing. How bullish, bearish, or neutral? Where do you lie on that scale? The second thing that you need to ask yourself is volatility, or more precisely, is uncertainty on the rise or decline? Now think about that. Typically, things that are in the future are less certain. And for that reason, volatility in the future in all types of market assets and market derivatives, particularly the VIX, in the future they tend to be higher in volatility because we really don't know the future. It's uncertain. So therefore, future volatility is usually higher. But there are cases where volatility has a tendency to rise into certain events. And so maybe we can either anticipate that rise, or because we know that something is going to come that's going to basically remove all the uncertainty, perhaps we have the opinion that volatility is going to fall. Another example is perhaps volatility is already at peaked levels. And we know from experience that things that reach extremes tend to go the other way. So that might be another consideration. So is volatility or uncertainty on the rise or decline is dimension number 2. The third dimension is, what is the time frame for your opinion to materialize? Is it going to be in a week because earnings are coming up next week? I'm not saying that they are, but I'm just using that as an example. Is it going to be in a month, 2 months, or do you anticipate the release of the new iPhone 6 to start fulfilling all kinds of pent-up demand for people out there looking to upgrade their iPhone? So maybe over the next year is when your opinion will materialize. That is the third dimension, time. So again, let's review those 3 dimensions. The first is your bullish-bearish stance, the level of volatility that you think is going to either be on the rise or decline, or the level of uncertainty, and in what time frame do you think all of this will occur? All right, so that's the 3D look at options, and that's really how professional traders look at options as well. And I'm sure that as a novice trader, you probably never even considered any of these things, and it's probably why you're having a hard time figuring out how these options thingies work. But this is it. This is what options are all about. All right, so let's first go to the first dimension, and there is a term, also one of the Greeks that are used in figuring out the options model, called delta. And delta is directly related to how bullish or bearish a particular option strategy is. So that's the first dimension. And so delta is going to be a very important thing that we're going to take very close look at in many of the future strategies that we work with. So delta, the definition of delta is the ratio of the change in price of Apple stock to the change in price of the associated or related Apple option. A positive delta is a bullish look at Apple. A negative delta is a bearish look, and a delta that is near zero is a neutral look. So it's kind of like, that's the scale, going towards either +1 or -1 or staying at 0. So you're either bullish, bearish, or neutral. The closer you get to 1, the more bullish you are. The closer you get to -1, the more bearish you are. The closer you get to 0, the more neutral you are. And neutral is very important because there are many strategies that allow you to play a neutral bias. That doesn't sound quite right. That's almost like an oxymoron now, isn't it? A neutral bias. All right, so this next chart here, this mind map is kind of showing you how you delineate between bullish and bearish, short and long, between options and stocks. So I'm going to leave that with you, and there will be a download, and you can take a look at that. And that's something that will help you get it straight in your mind when you're putting on a long call as opposed to a short call, or a long put as opposed to a short put, whether that is bullish or bearish. Very important. All right. So using delta. How do you use delta? Well, a delta of positive 1.0 or 1, remember I was talking about that scale from 1 to -1, means that the option price is moving up at the same rate as the stock. So a delta of 2 means it's moving at 2 times the stock. If it's a delta of 0.5, that means it's moving 1/2 as fast as the stock. Now you wonder, well, how can you have 2 times? Isn't 1 the maximum? Well, let's say you have 2 contracts. All the stuff that I'm talking about is sort of based on just 1 contract. So if you have 2 contracts, then you have a higher delta. So you have 2 contracts both at a +1 delta. Now, you choose a higher delta if you are more bullish and a lower delta if you are less bullish. So there are a number of ways that you can adjust delta up or down by adding or subtracting contracts. Now, there's another way that you can do it as well. So what I'm implying, at least in these last 2 scenarios here, is that we're either just using a very simple long call or a long put, either bullish or bearish, right? But there are option strategies where we combine long and long and short calls, or long and short puts, or long calls and long puts, or long calls and short puts, and all kinds of different variations. And the combination will give us some delta, some, relative delta. After you add them all up, you'll get some delta. And delta can be pushed either up or down by adding or subtracting more contracts, or spreading out the difference between the strike prices of contracts in these more complex strategies. All right? So those are ways that you can change your delta and your bullish or bearish stance or opinion on Apple stock. Adding more, subtracting more, changing the distance between the strike prices. All right, so the second dimension is volatility or uncertainty. They are synonymous. Things become more volatile if you don't understand what's going on. So for instance, you get more frightened when you walk into a dark room where you anticipate there might be danger in there. So it's uncertain, so your level of fear goes up. And fear and volatility are kind of like the same thing. Now, volatility is a statistical measure of how much Apple price is moving in a given time frame. So there is a very direct correlation to how fast the stock is moving up and down and how wide those moves are to uncertainty. So during uncertain moments, people tend to panic and price starts to move more erratically. And when price moves more erratically, volatility increases. Now, the interesting thing about volatility is that it has a direct correlation to the pricing of options. And so the higher the volatility, the more extrinsic value there is in the option. Now, extrinsic value means premium. Remember, I talked about premium in the first video. That is the extra price that's added on to an option, for the right to have certain, to be able to exercise those rights in the option. And that premium goes to the seller of the option. Now, that premium is a principal component of the pricing of option, and it can expand and contract. There's a very complex formula, and it's tied to time and tied to volatility, primarily. And so when things get more volatile, that premium tends to inflate. All right. So a higher volatility figure, or just when you're in a market that's more volatile, it makes Apple options more expensive. So assuming that the price is staying the same, if volatility increases, the price of that option will actually increase. And it can actually increase quite significantly. So here's something to consider with volatility. Now you have the option of either buying or selling calls or puts. Now, if volatility is increasing, or volatility is very, very high, that means that the relative cost of that long or put is very expensive. So it's probably best to try to buy options when volatility is low, when it's cheap. Because when it's cheap, you know that volatility, see, again, going back to the extreme, when something is at an extreme, very, very low, the chances are that it's going to go higher. So by buying options cheap, the chances are that volatility will rise if it's already low. It's not a certainty, but it could rise, and so that will benefit your long call or long put. Now, the other analogy to this, or the other idiom that you've probably heard, is buy low and sell high, right? So when options are cheap, you tend to want to be a buyer or go long calls and puts. When volatility is high, premiums are high, so it's probably better to be a net seller of options. Think about that. All right, now on to the next. The third dimension, time. Isn't that convenient? Time is 3D. Actually, time is 4D, but in options it's 3D. So as time goes on, we get nearer to the expiration of an option. And that's significant, because as we get nearer to the expiration date of an option, the premium in that option starts to decay. And it starts to decay at an exponential rate. So that's another thing to consider, because you can take advantage of that exponential rate of decay in premium, particularly if you're a seller of that option. If you're a seller, you want that premium to decay quickly, because that means that you make money more quickly. If you're a buyer or going long on options, as you get closer and closer to expiration, that's hurting your position. But as a seller, it's helping your position. So this works against the buyer of options and for the seller. All right? So if you believe volatility, for instance, will rise or fall over time, you can choose to be either a net buyer or seller of options, whichever gives you the best advantage. All right? So time and volatility kind of work together with one another. All right, now on to the last slide in talking about using both volatility and time together. Now, volatility, and these are real world examples. These are examples that you can start garnering specific strategies with Apple. So, for example, volatility virtually always rises as an Apple event approaches. So like when earnings approach, Apple volatility, or the Apple VIX, always rises. And therefore, option premiums start inflating. Not only earnings, but product announcements and other types of events that, see, the thing is, when there's an event in the future, traders and investors, they don't know what that event will portend. They can speculate on it, but in reality, they don't really know. It's not a certainty. So it's uncertain. And so therefore, volatility tends to rise into Apple events. Now, you can take advantage of that with different types of strategies. Now, a long calendar spread, for instance, can benefit from this by playing the anticipated rise of volatility over time. It plays an arbitrage between future option contracts and present option contracts. These are all things just to consider. I'm not getting into the specifics of these, just showing you how these three dimensions of time work for options traders. Now, volatility also, conversely, always drops dramatically immediately after the event is over, causing a phenomenon known as volatility crush. There are so many people out there that may have put a long call on, expecting their long call to take off after Apple takes off after good earnings. And let's say that it does take off. There's a possibility that even if Apple price goes up, if volatility drops sharply enough, that option contract may not make any money. I mean, that's just too much to handle for some people. They don't understand it. But it's all because of volatility being a principal component. And this is particularly true, especially if you have an option that is almost all premium and very little intrinsic value. And we'll get into what intrinsic and extrinsic value means. But let's just say that an option is almost all premium. And you're long on that option, and Apple has great earnings, or you got a long call, and Apple has great earnings, and then right after that earnings announcement, volatility just falls off a cliff, and that premium contracts down to hardly anything. And you're sitting there, you go back the next day thinking that you're going to make hundreds and hundreds of dollars, and you realize, man, I lost hundreds of dollars. That is why you need to understand the relationship of this 3D model, and what happens under certain events, and with Apple. I mean, it's very, very important. By understanding these things, you can take advantage of them and profit by them. Now, so traders can create strategies that isolate volatility behavior in profit as well. There are strategies that you can put together that will be irrespective of price. It won't care which way price is going. It will only react to volatility. And so you can put a trade on that will take advantage of only volatility moves. And that is powerful. Now, here's another thing. With time, like I said before, premium decays exponentially as expiration nears, the expiration of your options contract. So if price remains relatively the same, and or if volatility drops, the seller of premium can benefit. Now, some of these strategies that you may have heard of before that take advantage of this exact same outlook of the market or happening in the market are things like covered calls and iron condors. And they're very well-known strategies for taking advantage of this exact situation. So there you go. There's the 3D look at options. This is how professional options traders actually do it. Now, just because professionals do it doesn't mean that a beginner can't. A beginner needs to be cognizant of this 3D model. Again, it's your bearish or bullish view of the market. It's whether you anticipate volatility to rise or to fall, and how long you think that you're going to give this occurrence or your idea of the market, where you think it's going to go, to happen. Bearish, bullish, volatility, time. The three dimensions of options. See you next video.